The big, beautiful bill. Here's the deal. This law has some huge changes that could save you thousands of dollars in retirement, but only if you know about them and act quickly. Some of these changes are temporary, which means you have a limited window to take advantage. If you're 65 or older or getting close to retirement, this episode could literally put thousands of extra dollars in your pocket. Let's dive in. Good news first. Most of the tax system isn't changing. Your tax rates are still the same, from 10% up to 37%. Your standard deduction, that's the amount you can subtract from your income before paying taxes, is going up a little bit. For married couples, it's now $31,500. If you have kids or grandkids, the child tax credit is getting better. And if you're paying student loans, those rules aren't changing either. The bottom line, don't panic. The basics are staying put. Here's the biggest news for retirees. If you're 65 or older, you get an extra $6,000 deduction just for being a senior. That's on top of your regular deductions. But here's the catch. It only lasts until 2028. So you have 4 years to use this. What does this mean when it comes to your own finances? If you're in the 24% tax bracket, this saves you about $1,400 a year. Do the math. That's over $6,000 in 4 years. Let's move on to state and local taxes. Just got better. Remember that $10,000 limit on deducting state and local taxes? Well, now it goes up to $40,000. This is huge if you live in a high tax state, such as California. If you make over $500,000 as a married couple, this benefit starts to shrink. All those tax credits for solar panels and electric cars, most of them will end in 2025. If you've been thinking about going green, this is your last chance to get money back from the government. Another thing we see in this bill, more people will pay alternative minimum tax. Alternative minimum tax is that second tax system, and starting in 2026, more people will have to pay it. Think of it as the government's way of making sure wealthy people pay at least a certain amount of tax. If you're a high earner in retirement, this could affect you. What do you do with these changes? Well, if you have that extra $6,000 deduction, you might want to think about things we can do to utilize that. One thing we could do would move money to a Roth IRA. You know how you have to pay taxes when you take money out of your 401k and traditional IRA? Well, with this extra deduction, you can move $6,000 from one account from the IRA to the Roth IRA without paying taxes. Remember, the Roth is allowed to grow tax-free forever, so your kids won't pay taxes on it either when they inherit it. It's like getting a free upgrade. The next thing we could do potentially is take bigger withdrawals. So if you need a new car or want to do home improvements, now might be the time. In this next 4-year period, you get that extra $6,000 deduction, and we don't have to pay taxes on those funds when they come out. Another thing to note is you're going to want to plan around the deadline of 2028 if you're over 65 and getting that extra $6,000 per year tax deduction. And that could potentially change your strategy that you have in place now. So if you're getting the senior deduction, you might want to wait to move more money to the Roth IRAs. If you're not getting it, you might want to do the moves a little earlier. If you turn 65 between now and 2028, you get to use that extra deduction. If you turn 65 after 2028, you don't. This changes your strategy. If you're getting the senior deduction, you might want to wait to move Roth IRAs. If you're not getting it, you might want to do those moves earlier. Go ahead and move more into those Roth IRAs during that time. Another thing that's changed, starting in 2026, you can only deduct charitable donations if they are more than 0.5% of your income. You need to make sure they're over that threshold. And here's an example. If you make $100,000, your donations have to be more than $500 to show up on your tax return. One thing that we could do is if you're giving less than that, go ahead and put them in a lumpy amount into a charitable savings account like a donor advised fund. There's also a special rule for seniors. If you're over 70 and a half, you can give money directly from your IRA to charity. It's called a qualified charitable donation. This doesn't count as income, and it also avoids that new rule completely. In 2026, more people will hit the alternative minimum tax I mentioned earlier. If you think you'll be affected, consider taking more income in 2025 when taxes might be lower. Also, if you have investments that have gone up in value, you might want to sell some in 2025 rather than waiting. Other provisions do exist in the Big Beautiful Bill, but those cover the big ones that I see affecting folks who are near retirement or in retirement. If you're 65 or older, you have a 4-year window where the government is essentially giving you extra money. That extra $6,000 each year adds up to $24,000 in total deductions. For someone in a 24% tax bracket, that's about $6,000 in savings over 4 years, not pocket change. The key is act fast. Green energy credits end in 2025. The senior deduction ends in 2028. People who plan now will have more money to enjoy in retirement. Don't try to figure this out alone. Reach out to your tax professional or your financial advisor to understand these new rules and how they can directly impact you. Remember, it's not just about paying less in taxes. It's about having more money to enjoy your life and leave more for those you love. Next step, talk to a professional. Get some help. Figure out what you want to do. If you do want to buy solar or an energy efficient car, get after it. If you enjoyed this episode, please share it with another retiree. If you're interested in knowing how you can do and what type of income you can have in your retirement, click below to take the quiz. Thank you so much for your time. I'm Scott Frank with Stone Steps Financial.